George, the financial sector had a really good year last year, returning 25% plus. So, a really good 3 of the past 4 years. Why? What's the driver? What's behind the story?
Well, the sector is very diverse with different drivers of performance, but one of the key underlying changes has been the shift out of a period of zero interest rates, which has supported the sector's profitability and performance. So while interest rates have peaked, we think it's unlikely they go back down to the levels we saw in the decade post the financial crisis, and that has significant implications in terms of medium-term profitability. This is combined with a more settled regulatory environment, and with balance sheets in good shape, we're seeing significant amounts of capital being returned to shareholders by the banking sector. Within the insurance subsector, non-life insurers have also benefited from a supportive pricing environment, which again has been helpful for performance.
And looking at the next level down, what's your view on company fundamentals and valuations for 2025?
So we think the setup is attractive for financials. The sector trades at a 30% discount to the broader market. This compares to a 15% discount when the trust was launched back in 2013 and when profitability of the sector is lower than it is today. Operating trends are robust, and often share prices have been driven more by earnings upgrades than by a re-rating. So for example, European banks trade at just 7 times forward earnings, which is to the lower end of their historic relative range, and that's despite improved profitability and higher total shareholder return. So in what is a pretty extended and concentrated broader market, we think this improved outlook for financials is not reflected in their valuation.
Going back up a level to the macros, why do you think Trump 2.0 will be so good for financials?
So we expect some regulatory easing, which is very positive for the sector in terms of both capital return, but also in terms of M&A, and we are starting to see that coming through now. We expect a higher for longer rate environment, which is broadly supportive for the banking sector and life insurers. And should we see a pickup in terms of business confidence and activity, that again is positive for the broader financial sector. There are risks associated with tariffs, and we'll have to wait and see how those come through. But there also could be some positive consequences in terms of higher inward investment within the US associated with onshoring, and that could have a positive impact in terms of financing demand. So as the slide highlights, the impact of various subsectors will vary, but the trust has significant exposure to those subsectors we think will be positively impacted.
Can you expand a bit more on your trust's positioning and how that might change, bearing in mind what your outlook is for the rest of the year?
Yeah, so we're looking to take advantage of both cyclical and structural themes within the financial sector. We remain positive on the outlook for US and European banks, given that normalization in the rate environment, some potential for regulatory easing, capital return that is coming through nicely, and we're just starting to see an expectation of a pickup in terms of loan demand. We're also positive in terms of the outlook for reinsurers. So whilst they might have seen some modest decline in pricing at the January renewals, ROEs are expected to remain around the mid-teens levels. And given higher frequency of losses associated with climate change, higher bond yields, higher inflation, we think they might find a new normal higher in terms of the pricing environment. On the structural side, we continue to like the outlook for alternative asset managers. Given that shift in allocation towards that space, that's a long-term trend we expect to continue. We're also positioned to capture the growing role in data usage within financials. Both of those companies that can monetize unique data sets, such as exchanges and information service providers, but also for those companies that can use data as a competitive advantage within pricing. Examples of those would be Intact within the non-life insurance side, but also Mercado Libre as a lender in emerging markets.